Welcome guys, here's another educational video on advanced structure mapping. The reason I'm creating a video on this topic is because I see that some of you guys are still struggling on where you should take a trade, which 71 level you should mark out, is bullish or bearish, is price action bullish or bearish, or overall where to trade and where not to trade. So in this video I'm going to cover basically 3 or 4 big topics, and the first one will be bullish or bearish. Is price action moving into a bullish direction or a bearish direction? Should you trade longs or should you trade shorts? Second one will be that what 71 level should I trade? Because sometimes you pull out way too many 71 levels and you just get confused because you have 3 bullish levels, 4 bearish levels. Each of these are getting mitigated and you get lost in the noise and you don't know that where you should trade. Then we will talk about when to switch the bias, when to look for example, we are in a bearish flow and when that bearish flow changes, when we will say that, yeah, now they shifted to bullish. And basically this can be divided into 2 topics, short-term and long-term order flow. Because sometimes when you're in a bearish order flow, you can still take long trades. And we will cover that when that short flow changes to bullish and when we can confidently say that, yeah, now price action changed the long-term order flow into bullish and now we are prioritizing bullish trades over bearish trades. So in this video we are going to cover these topics, and let's just get started without wasting further more time. And I'm going to start on explaining with a simple arrow structure. In this video, I'm only going to use arrow structure. I'm not going to include live examples because it's pointless. You will actually understand from this little drawing right here that where you should trade, where you shouldn't trade, and what trade you are looking for. So first of all, what we see right here is the price is bearish, creating series of lower lows and breakout structures to the downside. And for the clearance, I just pulled out 3 Fibonacci ranges. The first range is pulled out from this protected high point because price took the liquidity of the previous high point. So this is a protected high point that broke structure to the downside. This protected high will be a key factor in this video. So just remember that this one is protected. Next one, obviously from the low below it, this level did not reach the 71 somewhere around here. In its middle of nowhere reversal, broke the structure from there again. Then we have another middle of nowhere reversal here, broke the structure again. So we could pull out 2 Fibonacci ranges, one from this high, one from this, and one from this, which leaves us with 3 Fibonacci levels on the charts, one here, and one here. This one is protected, remember for that. Alright, first of all, we identified a clean bearish flow because price is breaking structure to the downside over and over again, having a less recent protected high point. It's also important that this is the less recent protected high point. There can be another protected high point above it, which can be somewhere around here. Let's just title that this high point right here is protected as well. Let's just say that this is another protected high point for the clarity of the video. This will be important later again. So we just identified the flow that we are bearish, forming series of protected highs, forming series of higher, lower lows, lower highs, nice bearish structure with continuous breakout structures to the downside over and over again. What we are looking for, first of all, is obviously the confirmation of this less recent 71 level. This is the obvious base plan. If price retraces back up to this level, what we are looking for here is obviously the 15-minute confirmation entry model, where we are looking for a sweep, a shift, a volume, or a block entering on the 71 level and targeting the external low point with shorts. This is the ideal scenario. But what happens when price, for example, reaches the 71 level and then breaks the 71 level and breaks the high point as well? Now this will put you in a situation where you can actually pull out another Fibonacci range, but now into a bullish direction, because we see a short-term shift in the market right here on this line. We have a short-term shift in the trend, shift in the flow, and now price is short-termly bullish, which means that you can pull out a Fibonacci from the low point up to the high point, and now you can prioritize bullish trades over bearish trades on a short term. This is once again important that only on a short term. I will explain later that when can you prioritize bullish trades on a longer term. But right here, when this happens, what you do is that you just simply pull out a Fibonacci from this low up to this high point, and there will be a 71 level. Ideal scenario will be pretty simple. The ideal scenario here is if price retraces back down to the 71 level and confirms it, then you can take bullish trades. You can have 2 target points. First target point can be the 0 level of this bullish range. Second target point can be the 71 level of the next high point. So this is the 71 level of the next high point, and this can be targeted as well as the 0 level of the bullish external range. Let's just say that you target the 71 level, you take a long trade, and you TP out here. Okay, now we identified that the long-term flow is bearish, but the short-term flow changed to bullish because we are mitigating 71 levels after 71 levels, and we just shifted the short-term flow from bearish to bullish by breaking the last recent high point. But let's just say that price mitigates this 71 right here. What you do right here is that you immediately shift the order flow view back into bullish, and now you prioritize shorts over longs again. So the short-term shift is completed, and now we are looking for the long-term continuation again, because we are long-term bearish, meaning you are prioritizing the 71 level over the bullish trades now. So if this 71 level gets confirmed, then you take shorts. Okay, now you take shorts, price breaks the low point again, there's another external break of structure to the downside, best ideal scenario. But what happens when price cannot break this 71, cannot confirm the 71 level, but it breaks it? In this case, when it breaks the 71 level, you will, in this particular case that I'm explaining, you will meet with the next 71 level, which in this case will be the protected level. Okay, no confirmation being made right here, but now we mitigated the 71 level of the protected high point, which means we are again prioritizing bearish trades over bullish trades, and we are just looking for the entry confirmation plan on the 15-minute time frame, taking shorts. Again, you are targeting the external low point. Clean. Still in this region, when price retraced back up to this level, after breaking a high point right here and after forming, let's just say, a bullish short-term order flow, we are still prioritizing bearish trades on this protected level. The point when the short-term flow will change into a long-term flow will be when price breaks the protected high point. So if price breaks this last recent protected high point right here, it will mean that the the long-term bearish flow changes into long-term bullish flow. And in this case, when price continues all the way up to the high point right here with series of high lows, highs, lows, and breaks the high point of the protected region, it will mean that the flow has shifted from bullish to bearish on the long term, and now you are prioritizing long trades over short trades on the long term. And this is not just a short-term bullish flow, this is now a long-term bullish flow because the last recent protected high point broke. So in a nutshell, when the last recent protected high or protected low breaks, the long-term flow will change. In this particular case, when price breaks the last recent protected high point, it will mean that the bearish trend ended and now the bulls are replacing the bears, meaning we are prioritizing long trades over the short trades on the long term and not just on the short term. And everything that is located below the last recent 71 level, protected 71 level and last recent protected high point will be short-term flow. In this case, this will be a bullish short-term flow because it did not break the last recent protected high point. Once it breaks this protected high point, the flow will change from bearish to bullish on the long term. But now everything right here was ideal. But let's just take a look at not ideal scenarios, that what you can do, because things can mess up and lots of other 71 levels can be printed and you can get confused even with this structure mapping technique. So let's just say that price broke the last recent high point again. And now, after pulling out this bullish Fibonacci, it retraces back down to the 71 level. But in this case, it breaks the 71 level. Let's just say that there will be a break on the 71 level immediately. What you are left with right here is a broken high point, meaning the short-term flow shifted from bearish to bullish, but price just took out the 71 level and the low point that actually created the short-term shift. What you are left with here is basically two simple options that you can do. First option that you can do right here is you take a look at the movement that created the reversal on the deep bottom, because most likely price will, like in the 90% of the cases, price will react on this last recent 71 level, and from there it will break the high point. When this breaks, you are left with another low point, and this low point is circled right here. What you're doing here is that you're checking this movement. if is there any kind of volume. If there is volume on this movement, what you are doing is that you are pulling out another bullish Fibonacci range from low to high point, and now you are left with another 71 level located right here. Obviously, if it has an order block and a volume, it's only doable if it has volume and order block. And now what you do is that you look for bullish confirmations again right here. The reason you are looking for bullish confirmations here because the short-term flow shifted from bearish to bullish, and it has a pretty high chance to actually reverse price back up to the next 71 level, which is located here, and there you can look for shorts again. Now, obviously you're looking for your criteria system right here, and what it makes it even stronger than this setup right here is that this low is now counts as liquidity. It counts as inducement for the zone below it. Obviously, once again, if this one has liquidity, if this one has volume and order block, and now the liquidity gets swept into the 71 level, and you are taking longs up to the next 71 level right here, where you will be looking for shorts again, because this was only a short-term shift and not a long-term shift, because the last recent protected high point is still there. It's unmitigated, it's unbroken, so long-termly you are still bearish, but you could prioritize bullish trades on the short term because you had two other 71 levels located right here and right there. Now, obviously, when this 71 level on the bearish side is getting mitigated, this one right here, you still do the exact same progress that I just showed you. You are still pulling out, you are still switching down to the 15-minute time frame, and you are looking for bearish trades, targeting this external level, because long-termly, you are still bearish. Now, let's just say that right here, after price mitigated this deeper 71 level on the bullish side, took out the first 71 level, took out the low inducement, and it just mitigates this level. What happens when this breaks the low, breaks the high again without mitigating this 71 level here? What will be the case? Obviously, you are pulling out another bullish range coming from this low point up to this high point. You are still taking long trades on this 71 level located here, looking for bullish confirmations on the 15-minute time frame, still targeting this next 71 level. So it is still doable because short-termly you are bullish and you are looking for to trade these bull trades up to the next 71 level, where you can look for shorts again, targeting the external zero level. Okay, let's just mix things up a little bit more. Here's when things get a little bit complicated, but trust me, it is not complicated, because there's one sentence that I wrote down right here that, in a nutshell, the overall getaway and takeaway of this video is to take trade every single 71 level that you see. And this is the key sentence that you should remember from this video, is to trade every single 71 level that is visible and that you can pull out. And right now, here's when we mix things up. Ideal scenario again, let's just say that price comes back down, takes out this low point and mitigates this 71 level right here. Okay, let's just say you take a bullish trade right there, but you might think, and you might have thought earlier, like 5 minutes ago, that Marcel, yeah, we just had this low broken. So with this low broken, can we just pull out a bearish Fibonacci? Exactly. You can pull out a bearish Fibonacci from the high down to this low point. You can pull out a bearish Fibonacci, because in reality, what price did is that it broke a low point from a high point. If a low breaks from a high, you are pulling out a Fibonacci. And in this case, you enter in a long trade. What you can do right here is that you can TP out on the 71 level. What I suggest you to TP out on the 71 level is that when this bearish movement has high volume and a beautiful order block located at the 71 level. In this case, you still have a nice chance to grab anywhere in between 1 to 4 to 1 to 10 restore ratio. You just take that long trade, TP out here anywhere in between 1 to 4 and 1 to 8. That's the most likely restore ratio available from this trade. And then you look for bearish trades again. And here comes this sentence again, that trade every single 71 level that you see. Obviously, every single 71 level that is valid, because this high point broke the low point. Meaning if this high broke a low point, there can be a 71 level that initiated the break. But at the same time, this low point created a flow that broke the high point, which means there is a 71 level that can be traded. So you trade this bullish 71 level, and at the same time, you trade the bearish 71 level, because still there is a pretty high chance that price will react right there and it will reverse back down to the bearish direction because you are long-term bearish. So once again, trade every single 71 level that you see with the same logic applied. Now, another mixed up scenario, because yeah, I want to include every single structure mapping 71 level marking out scenario that might come up with in front of you when you are trading in live. What happens when price, for example, it arrives into the 71 level, but then it creates a pullback and goes deeper into the 71 level? Here, let's just say that it, yeah, for easier understanding, let's just say that it doesn't mitigate the protected level, but at the same time, it breaks the high point in a short-term flow. It breaks the high point and creates a nice low point, and the really, let's just say that really beautiful order block and really beautiful volume being created on this movement. What should you do here? Because you are inside of the next 71 level on the bearish perspective, but right here you have a beautiful bullish break on the short-term flow perspective that initiated the break of the high point with a beautiful order block and beautiful volume. What you can do here is that since you are inside of the 71 level, you can take shorts. If there's a short trade forming right here, take that short and take that short down to this 71 level, to this bullish 71 level, where you can look for longs again, targeting the protected level. Because short-termly, you are bullish until price reaches the 71 level. And when the 71 level protected level is getting reached, price has a really high chance to reverse back down into a bearish direction, like I told you at the beginning of this video. So one more takeaway. When price reaches this high point and it forms a confirmation setup because you are inside of a 71 level, bearish 71 level, and the long-term flow is bearish, take that short trade and TP out on this bullish 71 level, because price has a significant chance to actually reverse right there as well, because it just created the break of this high point with a really nice volume gap and a really beautiful order block. So take that short, TP out here, collect that 1 to 4, 1 to 3 restore ratio, be happy with the 3%, 4% made right there, and look for bullish trades again. If there's a bullish trade, take it up to the next 71 level. But if there's no bullish trade right there, let's just say price breaks this 71 level, you have a winning case again. You took a short trade from here to there, won 4%. Another high, another break, another low. Right here, this high point broke this low point here, meaning you can pull out the Fibonacci from high to low. You can look for short trades again on the 71 level. And in this case, when this happens, I would actually not care about these longs anymore, because price just reacted on a really significant key area and it's long-term bearish, so it has a higher chance to break the low point than to actually react on any of these given 71 levels now. Okay, last thing I want to explain is that when I told you that this high point breaks, the protected high point breaks, the flow will shift from bearish to bullish on the long term. But we just made another protected high point here. And you might ask that, wait, don't we have another protected high point there? Isn't this high point protected as well? So what we are doing right here, yeah, let's just say it's a little above it. Let's just say that, for example, here is that protected 71 level. Now in this case, when the last recent protected high point breaks, I do not care about this protected 71 level anymore. I do not care about the, for example, Fibonacci pulled out from this high to this low where the 71 level will be located there. I do not care about any other 71 level because the protected high point is broken. So I do not look for short trades here anymore. And when price reaches that level by breaking that bearish protected high point right here, I do not look for direct 50-minute entries anymore on these 71 bearish levels. So when price reaches this next protected level, I'm not looking for 50-minute confirmations anymore. What I'm looking for right here is a break of a 4-hour low point. When price breaks this 4-hour low point right here, I will be pulling out the bearish range from high to low, 71 here. And in that case, I will be looking for short trades into leading down to the break of the structure. So this is the advanced structure mapping. I do believe that you have to watch this video few times and you have to take notes. So please take your time, take notes, study this several times. And once you studied it several times and learn the mechanism of this advanced structure mapping, you will, I promise you, I really promise you guys that you will get better at trading significantly and your results will get better once again significantly. So happy learning, guys. Thank you for watching this video. Cheers and goodbye.